Did you know the average bear market lasts about 9.6 months, while the average bull market runs for 2.7 years, meaning the stock market spends significantly more time growing than declining. Since 1928, the S&P 500 has spent about 78% of the time in a bull market and only 22% in a bear market. That means if you're invested for the long haul, the odds are heavily in your favor. Market drops are an inevitable part of investing, yet many people panic when they begin. Today, we're unpacking the frequency of the drops, what causes them, and how you can stay calm and strategic when the market takes a hit. Welcome back to Simply Money. Most people view market drops as a reason to sell, fearing financial loss. But these corrections, defined as declines of 10 to 19%, are a natural part of market cycles. In fact, they've occurred 10 times in the past decade. And what about bear markets? Those are more severe declines of 20% or more. Those are less common, but equally important to understand. Without this context, you might let fear dictate your decisions, potentially missing out on long-term gains. Let's start with market corrections. When the market drops 10 to 19%, corrections happen often averaging about one per year. Here are some examples from the past decade. January 2018, a 10% drop sparked by concerns over rising interest rates. October 2018, a 19% drop driven by trade tensions and global growth fears. September 2020, a 10% correction caused by tech stock volatility. Despite these dips, the market has consistently rebounded, often reaching new heights within months or years. Now let's look at bear markets. This is when the market corrects or drops 20% or more. A bear market is a more severe decline of 20% or more from its recent peaks. In the last decade, a notable example is March 2020. The market plunged 34% in just 33 days due to COVID-19 pandemic. Bear markets are less frequent than corrections, occurring roughly once every 7 years. But like corrections, they pave the way for long-term recovery and growth. A bear market reflects a sustained decline in stock prices marked by investor pessimism. They're often triggered by recessions, financial crises, or major global events. And understanding these periods can help investors stay the course and avoid rash decisions. Let's break down and look at some of the bear markets in the S&P 500 historically. You have the Great Depression in early markets. September 1929 to June 1932, there was a decline of 86.2%. The recovery time, 12.6 years. Biggest drop and the longest recovery in history, but some steps have been taken to reduce this type of thing from happening again. Shortly after that, March 1937 to April 1942, the stock market declined percent. The recovery time, 7.1 years. So the 30s and early 40s were not a good time for investing. Two of the worst times ever for the stock market because of the Great Depression and the ensuing war. Let's look at the post-war era. May 1946 to June 1949, there was a 29.6% drop. The recovery time, 3.1 years. August 1956 to there was a decline of 21.6. Recovery time, 11 months. Again, these recovery times means they re-reached their peak and continued growing from there. And remember, 78% of the time, the market is in a bull market. It's these bear markets that scare people. It's these bear markets and the recoveries we talked about that scare people, and they begin selling when the market's down. Imagine if you had bought on the 86% drop, and then when it recovered, all that growth that you would have received. But people are selling. Here's another one. December 1961 to June 1962, 28% drop. Recovery time, 14 months. 1968 to 1970, there was a decline of 36%. Recovery time, 21 months. Then you have stagflation and the oil crisis. 1973 to 74, decline of 48%. There was hyperinflation, recovery time 5.8 years. So again, what are you getting out of this other than, oh my God, there's some huge bear markets and it's going to take sometimes months or even years to recover? The take of this for me is you're in this for the long term. If you're investing for 1 or 2 years, yes, you stand a chance of losing money because there's going to be corrections in bear markets. But if you're in it for the long haul, 10, 15, 20 years, you can see the recovery time is there. November 1980 to August 1982, declined 27%. Recovery time, 3 months. Imagine that. Imagine yourself in 1981, 82. You're freaking out. It's down 27%, and you're selling, you're getting out, and you're locking in those losses. Then 3 months later, it's back where it had been. That panic caused you to lose not only what you locked in as losses, but it kept you from gaining the future growth. Let's look at some more modern market crashes. 1987, August to December, declined 33%, recovery time 20 months. But if you're in it for 5, 10, 15 years, you recovered your money and then got all those gains, but you panic and you sell. March 2000 to October 2002, 49% drop. The dot-com bubble took 4.7 years for full recovery. October 2007 to March 2009, the housing bubble, 56.8% drop. Took 4.1 years but it's recovered. Look at what it was right before October 2007. Look at the stock market and where it was at, and look where it's at today. That's long-term growth, and that's what you're after. You're not in this for the short term. More recent, we talked about this, COVID, February 2020 to March 2020, 33.9% drop, recovered in 5 months. And the most recent one, January 2022 to October 2022, a 25% drop, recovery time 18 months. And yes, it's recovered. Let's look at in a little more in depth at one of the most recent and focus on the March 2020 drop of COVID. The 34% plunge was shocking, yet the market recovered fully within months, reaching all-time highs by the end of the year, and people were panic selling in March of 2020. You know what I was doing in March of 2020? I was looking for opportunities to invest more, and that's the mentality you have to have because that's where you make your gains. The best bet, dollar cost average, whether the market's in a bull market, a recovery, a recession, a bear market, it doesn't matter. Dollar cost average, $100 every month, $500 every month, whatever you're investing every month, every quarter, whatever your frequency is, invest and continue to invest no matter the market conditions. And that's how you build wealth and allow compounding to work for you. Don't go into it thinking it's going to be quick and that you're going to get rich in a year or 2 years. This is long-term financial growth. Market drops, whether they're 10 to 19%, corrections, or 20% plus bear markets are a normal part of investing. Understanding their frequency, the historical recovery patterns, these can help avoid fear-driven mistakes and stay the path to building wealth. Have you experienced a market drop that impacted your investment? I have. I've seen my portfolio drop tens, $20,000, $50,000 at time. That's okay. It recovers and it grows from there. Leave your comments below. What are some things that scare you? What are you fearful of? What have you ridden through a market correction, a bear market? And what did you do during it? And are you glad that you stuck with it? Or are you upset that you sold? Give us your feedback. What's your thought? Don't forget to hit that like and subscribe button. Hit the little bell so you're notified of upcoming videos. And we'll see you next time on Simply Money.